Ladies and gentlemen, listen carefully. I am not talking about another ordinary move in silver, another burst of enthusiasm, or another reaction to a central bank headline. I am talking about the possibility that capital itself has begun changing direction. Most investors will not recognize that rotation when it begins. They will see volatility, conflicting data, and temporary weakness. They will wait for certainty. By the time certainty arrives, the most important positioning may already be complete. You need to understand what is happening beneath the visible market. The financial system has been built around one dominant assumption. Debt can expand faster than productive capacity without eventually changing the value of money. Governments borrowed because deficits appeared manageable. Companies borrowed because refinancing remained available. Households borrowed because credit became part of ordinary life. Investors accepted increasingly expensive assets because liquidity kept flowing, and policymakers repeatedly protected the system whenever pressure appeared. For decades, that structure rewarded leverage, duration, and confidence in paper claims. But debt is not free capital. It is a claim on future income. When debt grows faster than the income required to service it, the system becomes dependent on lower rates, easier money, and constant intervention. That dependency is now the central issue. The problem is not merely that governments owe more. The problem is that the entire financial structure has less room to tolerate normal interest rates, slower growth, or prolonged liquidity restraint. Every attempt to restore discipline exposes fragility. Every attempt to protect fragility weakens the currency. This is not speculation. It is the logic of a late-stage debt cycle. If central banks remain restrictive, refinancing pressure rises, weak borrowers fail, credit tightens, asset prices become unstable, governments face higher servicing costs at the same moment fiscal demands continue increasing. But if central banks reverse course aggressively, liquidity returns at the expense of purchasing power. Inflation may temporarily cool, but the underlying monetary pressure does not disappear. It moves from financial stress into currency stress. Policymakers are trapped between protecting the system and protecting the money used to measure that system. History has proven this again and again. Highly leveraged systems rarely choose a clean liquidation when the political cost becomes unbearable. They choose delay, they choose intervention, they choose gradual dilution before open contraction. That does not mean collapse occurs tomorrow. It means the direction of policy becomes increasingly predictable as the available choices narrow. And when sophisticated capital understands that narrowing before the public does, allocation begins to change quietly. That may be what you are seeing now. The early phase of a market rotation does not look dramatic. It looks confusing. Hard assets hold strength despite shifting economic forecasts. Central banks diversify reserves. Long-term capital begins seeking scarcity, durability, and assets that cannot be created by decree. Meanwhile, the majority remains focused on daily inflation reports, earning surprises in the next policy meeting. This is how the unprepared majority gets trapped. They watch the event. Smart money watches the structure producing the event. Silver sits directly inside that structure. It is not simply a commodity, and it is not merely a smaller version of gold. Silver occupies a rare position between monetary protection and industrial necessity. When confidence in currency weakens, investors search for tangible assets with limited supply. When electrification, energy infrastructure, advanced electronics, and high-efficiency technologies expand, industry also competes for silver. They only need to strengthen together enough to pressure a market that is far smaller than the pools of capital surrounding it. You must think about scale. Global capital is concentrated in sovereign debt, equities, pension assets, bank deposits, and currency-based instruments measured in trillions. The investable silver market is tiny by comparison. It does not require complete abandonment of the financial system to create a major repricing. It requires only a marginal shift in perception. A small percentage of defensive capital moving toward a constrained asset can produce an effect that looks disproportionate only to those who ignored the market size. This is why silver can remain quiet for years and then move with extraordinary force. The pressure builds invisibly, supply responds slowly, investors underestimate the change, then perception turns. Liquidity tightens and buyers discover that available exposure is not as deep as they assumed. The move appears sudden, but the causes were developing long before the price confirmed them. Most people will still call it a temporary trade. They will say the system remains stable. They will insist policymakers are in control. They will wait for a pullback, a clearer signal or permission from the same consensus that failed to recognize the shift. But major rotations never announce themselves in a way that makes everyone comfortable. They begin while confidence in the old regime still looks reasonable. The real question is not whether every signal is perfectly aligned. The real question is whether the balance of pressure has changed enough to force capital toward protection. Debt is rising. Policy flexibility is shrinking. Currency credibility is being tested. Industrial demand is becoming more strategic. Supply cannot be expanded instantly. These forces are not isolated. They are converging. And when structural forces converge inside a small market, the consequences do not remain small. That convergence becomes more important when you examine how silver supply is actually created. Most investors imagine that higher prices automatically produce more metal. So they assume miners can simply increase output. But silver does not respond like a manufactured product. New mines require years of exploration, permitting, construction, and infrastructure. Even then, much of the world's silver is produced as a secondary result of mining copper, lead, zinc, or gold. That means silver supply is often determined by the economics of different metals. This matters because a market cannot solve a shortage with production that may take a decade to reach scale. Above-ground inventories can absorb pressure for a time. Recycling can increase, and industrial users can improve efficiency. But none of those responses is unlimited. Once available supply begins tightening, price must do more of the work. It must discourage consumption, attract new investment, release holdings, and compensate producers for the risks required to expand capacity. That is where the rotation becomes dangerous for anyone waiting on the sidelines. When capital moves into a deep market, the adjustment can remain orderly. Large bond and equity markets can absorb enormous flows without exhausting available inventory. Silver is different. It is financially traded, industrially consumed, and physically limited. A wave of investment demand does not enter an empty system. It enters a market where manufacturers already require access to metal and where many holders are reluctant to sell during monetary uncertainty. You need to understand the conflict this creates. Industrial buyers need silver to maintain production. Defensive investors want silver because they distrust the long-term purchasing power of currency. Speculators enter because momentum is rising. Institutions begin seeking exposure because portfolio correlations are changing. Each group arrives, but all of them compete. That is how a modest rotation can become a powerful repricing mechanism. Most people will misunderstand the first stage. They will see sharp advances followed by violent reversals and conclude the move has failed. They will confuse volatility with invalidation. But volatility is what you should expect when an ignored asset is being revalued under new assumptions. Buyers and sellers are not merely debating today's price. They are debating whether the monetary regime, industrial demand profile, and acceptable scarcity premium have changed. There will be rallies that move too quickly. There will be corrections designed by market structure, leverage, profit-taking, and fear. There will be headlines claiming the entire thesis is finished. There will be moments when silver appears weaker than the forces supporting it. None of that should surprise you. Every major structural move contains periods that force impatient participants out before the larger trend becomes obvious. I am not telling you that price can only rise. I am telling you that the framework used to value silver may be changing. That distinction is critical. A temporary trade depends on sentiment. A structural rotation depends on capital recognizing that the previous allocation no longer provides adequate protection. Once investors begin questioning the real return of sovereign debt, the durability of currency, and the stability of assets dependent on endless liquidity, scarce tangible assets become more than alternatives. They become insurance against policy failure, and insurance is cheapest before the emergency is recognized. Look at the broader debt cycle. Governments cannot easily reduce deficits because modern economies have become dependent on public spending, transfer programs, subsidies, defense commitments, and interest payments. Raising taxes enough to close the gap can weaken growth and intensify political resistance. Cutting spending can produce the same result through a different channel. Borrowing therefore continues, but continued borrowing increases the supply of debt precisely when investors are becoming more sensitive to inflation and fiscal credibility. Who absorbs that debt if private demand weakens? This is the question policymakers do not want markets to ask. If yields rise enough to attract buyers, debt service costs become heavier and financial conditions tighten. If central banks suppress yields or expand their balance sheets, the currency bears more of the adjustment. Either outcome reinforces the argument for assets outside the liability structure of governments and banks. Silver does not promise a coupon. It does not depend on a borrower's ability to repay. It is a tangible input and a monetary metal whose supply cannot be expanded with a vote. That does not make it riskless. It makes it structurally different. Most portfolios were designed during decades when falling interest rates supported both bonds and equities. Investors learned to believe that diversification between paper assets was sufficient. But when inflation, fiscal dominance, and monetary intervention become the common force affecting both sides of a portfolio, traditional diversification can weaken. Assets that appeared separate begin responding to the same underlying variable, liquidity. This is why the next rotation may not look like the rotations investors studied in recent history. It may not simply move from technology into value, from growth into defensives, or from one geographic market into another. It may move from financial promises toward monetary scarcity. It may move from nominal return toward real preservation. It may move from assets dependent on confidence toward assets purchased because confidence is declining. Silver holders must clearly recognize the difference before the crowd does this time. Before the crowd recognizes that difference, the first signals will appear fragmented. One market will weaken while another strengthens. Bond yields may rise even as growth slows. Inflation may retreat while households continue feeling pressure in food, housing, insurance, and energy. Policymakers will describe these problems separately because acknowledging the common source would expose the limits of the system. But you cannot evaluate these developments in isolation. They are connected through debt, liquidity, and confidence. This is where most investors lose perspective. They assume every problem has an independent solution. They believe higher rates can defeat inflation without damaging leverage. They believe governments can continue borrowing without affecting currency credibility. They believe central banks can provide emergency liquidity without changing long-term purchasing power. They believe asset markets can remain permanently detached from productive growth. Each assumption may survive for a time. Together, they create a structure that becomes difficult to sustain. I want you to understand why capital rotation begins before a crisis becomes visible. Large institutions cannot reposition all at once. Their portfolios are large and the markets they enter may be small. They must move gradually. They reduce exposure at the margin. They extend or shorten duration. They accumulate assets quietly. They hedge currency risk. They seek optionality before the reason for that optionality becomes obvious. The public behaves differently. The public waits for headlines. It waits for price confirmation. It waits until remaining unprepared becomes greater than the fear of acting. That delay creates the acceleration you see late in a major move. Early buyers accumulate when uncertainty is high and competition is low. Late buyers arrive when certainty feels high and available supply is already tightening. That is why preparation cannot be based on prediction. You do not need to know the date of the next policy reversal, banking disruption, debt scare, or geopolitical shock. No one can know that with precision. What you can evaluate is whether the system has become more resilient or more dependent. You can evaluate whether debt is being reduced or refinanced. You can evaluate whether real purchasing power is strengthening or eroding. You can evaluate whether supply is expanding fast enough to meet strategic demand. Those questions lead to a different conclusion than the daily market commentary. Silver may decline during periods of forced liquidation. It may be sold when investors need cash. It may suffer when leveraged positions are unwound. That has happened before and it can happen again. But temporary liquidation does not eliminate the structural case. In fact, forced selling can create the conditions for stronger ownership later because metal moves from weak hands seeking liquidity into stronger hands seeking long-term protection. You must separate price from purpose. If you hold silver only because you expect a surge, volatility will control your decisions. If you understand it as part of a broader strategy for monetary uncertainty, industrial scarcity, and portfolio resilience, you will evaluate it differently. That does not mean ignoring risk. It means defining the role of the asset before emotion defines it for you. No strategy should depend on one outcome. You should not build your financial future around a single metal, a single forecast, or a single dramatic target. Wealth protection comes from understanding exposure, liquidity, time horizon, and concentration. But the opposite mistake is equally dangerous, holding no protection because the current system has not yet failed visibly. Stability can persist longer than expected, but when the underlying structure changes, repricing can happen faster than preparation. This never ends quietly. Later stage debt problems may be postponed, transferred, or disguised, but they are not erased. The burden moves between borrowers, taxpayers, savers, and currency holders. If defaults are avoided, dilution becomes the adjustment. If dilution is resisted, financial contraction becomes more severe. Someone absorbs the loss. The political process determines where that loss appears, but it cannot eliminate the arithmetic. Silver holders should pay attention to that arithmetic, not the noise surrounding it. Watch whether fiscal deficits become structural rather than temporary. Watch whether interest expense consumes a growing share of public resources. Watch whether central banks are forced to choose financial stability over inflation discipline. Watch whether industrial users become more concerned about securing supply than negotiating price. Watch whether investment demand begins rising during periods when traditional assets no longer provide reliable protection. These are not signals of guaranteed appreciation. They are signs that the conditions for rotation are strengthening, and once rotation begins, it feeds on itself. Rising interest in hard assets attracts research. Research attracts allocation. Allocation tightens supply. Tighter supply moves price. Price movement attracts public attention. Public attention brings speculative capital into a market already experiencing structural demand. What began as quiet protection can become visible momentum. The danger is not that every investor will suddenly abandon the financial system. The danger is that too many investors may seek limited protection at the same time. Silver does not need universal acceptance. It only needs a meaningful change in allocation from a world holding enormous quantities of financial claims. That change may already be underway right now, and the evidence will become clearer only after positioning becomes more expensive. Positioning becomes more expensive because the market begins charging you for certainty. Early in a rotation, uncertainty is abundant and competition is limited. Later, confidence rises, attention expands, and every new buyer is competing against investors who prepared before the narrative became obvious. That is why waiting for universal agreement is not caution. In structural markets, it can become the most expensive decision of all. You need to understand what this means for your thinking. The objective is not to predict a silver price or to assume that every interruption is meaningless. The objective is to recognize whether the forces driving long-term demand are strengthening while the flexibility of the financial system is weakening. When those two conditions develop together, the probability of a significant repricing increases. Even if the timing remains uncertain, most people want a single signal. They want one announcement from a central bank, one decisive breakout, or one crisis that proves the argument beyond doubt. Markets do not offer that kind of permission. They provide incomplete evidence, shifting probabilities, and uncomfortable choices. By the time the evidence feels complete, the price often reflects information that early observers acted on years before. This is why discipline matters more than excitement. A holder does not respond to every headline with panic or euphoria. A serious holder studies allocation, liquidity, storage, counterparty exposure, and personal time horizon. Physical metal, mining shares, futures, and exchange-traded products do not carry identical risks. They respond differently to volatility, leverage, operational problems, and market stress. Understanding what you own is as important as understanding why you own it. You should also understand that wealth protection is not the same as chasing a dramatic return. Protection means maintaining purchasing power, preserving flexibility, and reducing dependence on one financial outcome. It means recognizing that cash provides liquidity but can lose real value. Bonds provide income, but depend on repayment and currency stability. Equities provide productive exposure, but remain sensitive to valuations and liquidity. And hard assets provide scarcity, but can experience severe volatility. Every asset solves one problem while creating another. The mistake is not choosing imperfect assets. Every asset is imperfect. The mistake is believing the system has removed risk simply because markets remain calm. Calm conditions can hide growing imbalance. Low volatility can encourage leverage. Rising asset prices can disguise declining monetary quality. Strong nominal returns can conceal weak real returns. A portfolio can appear wealthier while its future purchasing power becomes more vulnerable. This is why you must measure success against what your capital can ultimately buy, not only against the number printed on an account statement. The next market rotation may begin with that realization. Investors may stop asking which paper asset will rise fastest and start asking which assets can survive persistent deficits. Policy intervention and declining confidence. They may begin prioritizing ownership over promises, scarcity over unlimited issuance, and resilience over maximum nominal yield. Silver is not the only beneficiary of that transition, but its dual monetary and industrial role gives it unusual sensitivity to the change. There will be resistance. Established narratives do not disappear quickly. Analysts will argue that inflation is contained, debt remains manageable, and policy tools are sufficient. Some of those arguments may appear correct for extended periods. Systems can remain functional while becoming increasingly fragile. But functionality is not the same as sustainability. A bridge can carry traffic while its structure weakens. The danger becomes visible only when the load exceeds what the system can absorb. Depth is that load, interest expense is that load, political reluctance to accept contraction is that load. Industrial competition for scarce resources is that load. Each pressure alone may be manageable. Together they reduce the margin for error. A policy mistake, liquidity shock, or confidence break does not need to destroy the system to change asset allocation. It only needs to convince enough capital that old balance no longer provides adequate protection. When that conviction spreads, rotation accelerates. Prices move before explanations become widely accepted. Scarcity becomes visible after availability has already tightened. Investors who dismiss protection begin competing with those who accumulated it patiently. The opportunity does not disappear, but the terms change. What was once ignored becomes expensive. What was once considered unnecessary becomes urgent. So listen carefully to the message beneath the volatility. Do not confuse temporary calm with permanent stability. Do not confuse policy intervention with a solution. Do not confuse nominal wealth with preserved purchasing power. And do not assume you will be given a clear warning before capital begins moving at scale. The warning is the structure itself. The debt cycle is narrowing policy choices. Monetary credibility is facing pressure. Industrial transformation is increasing strategic demand. Silver supply remains slow to respond. Global capital remains enormous relative to the market it may eventually enter. These conditions do not guarantee a straight line, but they create the foundation for a rotation that could surprise investors who continue looking backward. Most people will recognize the shift only after it changes price.